welcome to Gulf Intelligence Halftime Talk feature interview, and we're joined today by Mr. David McWilliams, well-known author, economist, and broadcaster, one of Ireland's greatest economists, and ranked globally in the top 10. So we're honored, David, to have you join us this morning.
Sean, it is a pleasure. It is a pleasure. How's everything with you?
All good, all good. Yeah, you know, survived the big lockdown and sort of looking to where we go from here, I think. Feels in a certain ways we're at kind of a crossroads in this whole thing. That, you know, we've survived. Obviously, the economies have taken a massive hit, and we sit at the end of the second quarter, looking at the second half of the year. And we just had the IMF report, and unfortunately, worse than expected. Instead of getting a C minus, it looks like the world economy got a D, and forecasting a 4.9% decline in global GDP as compared to 3% only last month. So that's kind of our backdrop. Big sweeping sort of view, David, your general overview?
I suspect the IMF were extremely concerned about this second, it's not even a second wave in the United States, it's the end of the first wave. So most forecasters, you know, Sean, as I've referred to this before, I think this thing is something it's not a recession, it's not a depression, it's like something you could call a pandession, which is a rolling recession caused by a health crisis. And obviously, the end of that recession, which is normally in economics a function, Sean, of rebuilding your capital base, of sensing demand elsewhere, coming up with new products, etc., is going to be dictated not by the normal commercial cut and thrust or economic policy per se, but by the outlook for the health of the citizens of the country. And the United States has proved itself to be what we would regard, when you and I were in school together many years ago, Sean, as a third world country, bookended by New York and San Francisco. I wouldn't even put LA in there, and it, you know, a country that cannot protect its citizens against a disease that was dismissed by its president as a bit of a flu or a common cold. So that has revealed something quite disturbing about the United States, and the United States is still the biggest economy in the world. And what is revealed is that the underlying conditions, remember we talk about when people are affected by COVID, the extent of their illness is a function of these underlying conditions, whether it's lung problems or age or whatever. The underlying conditions that have been exposed in the United States is that the wealth of the United States is masking this extraordinary divergence in opportunity, divergence in education, divergence in the ability for the state to protect its health system and consequently its citizens. So I think the IMF's view, if I might say so, might be more exposed by the idea of like, what else is there under the bonnet in the United States that we're not too sure about?
It does seem like a rather substantial correction. The IMF had a report only a month or so ago at 3%. We're talking about nearly 2 full percentage points in any year would have been sizable.
I can only put that down to a reappraisal of their perception of the strength of the United States economy coming out of this. Again, don't forget that since the IMF would have thought about this report, you have the Black Lives Matter issue emerging in the United States as well. You have political instability, you have a president that seems to me to be slightly unhinged, and not just to me, to many, many people. So there's a cloud over the United States.
He's been unhinged for a long time. It doesn't seem to have troubled his ability to achieve a lot and get into the presidency.
But the point is now, I think there's a cloud over the United States that is bigger now than COVID. Okay, and that's a geopolitical cloud, a political cloud, an internal domestic cloud. That's the first thing. The second thing is maybe a fear that interest rates aren't being passed through. So basically what we have is that there's been basically fiscal policy and monetary policy, Sean, which used to be in the old days quite distinct, have now become one, okay? And the Federal Reserve is simply buying up as much of the American debt is possible. Basically, it's buying up everything that isn't nailed down. And the assumption is that there will be a pass-through of low interest rates and loose monetary policy down to the ground. Now, maybe the IMF is worried that, in fact, the real economy won't absorb that money as quickly as it should do. It's worried about that pass-through. It's worried about the banks not actually being functional. And taken all together, I think the fear is that the United States becomes more of a drag on the global economy. The other thing is you look at Europe. The data out of Europe is going to rebound rapidly this month, okay, Sean, this and next month, because the trough was so significant in April and March. But there is a sense, if you listen to the ECB, that normality, i.e. what it pertained in 2019, will not reemerge until about 2021, 2022. That's the latest ECB forecasts. So that again shows very soft demand. It shows very high levels of unemployment. It shows very high levels of government deficits and debts, all against a background of the central bank, again, a bit like the Fed, unveiling a toolbox of policy options, which nobody ever thought they would do. I mean, my own view is that the European Union may well see negative interest rates, what's called dual interest rates. There's all sorts of stuff in the mix. So
if you take that kind of fiscal monetary stimulus, we saw a lot of it in the Q2 period, trillions of dollars out of the US and similar, not quite as much in Europe, but nonetheless, the stimulus was massive. The main street, it would indicate, was suffering greatly, but the Wall Street and the financial markets were on a tear.
Yes. Yeah. Well,
do you expect that correlation or uncorrelation to continue through the second half of the year, or will the day of reckoning come?
Well, I mean, ultimately, let's look at the amount of money, Sean. I think we have become desensitized to these figures. But if you think of $1 trillion, if you want to put a sense of how big that is, Sean, it's a one with 12 zeros after it, okay? And if you and I were to spend $1 million a day, Sean, it would take us 1,747 years to spend $1 trillion, which brings us right back to even before the Greeks, okay? So what I'm trying to say is these figures are enormous, right? But what they do is they inflate the asset markets dramatically. And what they do is they drive a wedge between fair value, as reflected in the potential growth rates of stocks and growth rates of the economy, and actual value. So that wedge is being driven before. I always like to compare it to Salvatore Ferragamo, Sean. Are you aware of this? Are you aware of this?
Is that a fashion designer?
Exactly. Okay, so Salvatore Ferragamo is a fashion designer, Italian fashion designer, original, the head of the house. Okay, he's gone now, and it's a big designer. But he came up with wedges for women. Okay, and wedges for women became the most sought after fashion item in the 1930s and all the way through. And why? Because basically Salvatore was driving a wedge between women's actual height and their post-wedge height, which meant they could wear nicer clothes, they felt taller, all that things hanged off. Right? So I always think that QE, or this exceptional monetary policy, is a bit like Salvatore Ferragamo, okay? It's a little bit like wedges for women. So basically, rather than being your actual height, you're 2 or 3 or 4 or 5 inches higher, and you feel better. So consequently, the companies, rather than have their actual share price, which reflects their fundamental value, they're pushed up 7 or 8 notches higher. And then the problem with that, Sean, is to look like that all the time, you've got to keep wearing the wedges. So to stay up there all the time, you've got to keep this stimulus going. So clearly there is an issue with the day of reckoning. There's no doubt of that.
Of that financial market stimulus, there is also in Q2, and now how long will it last? And I mean, my overall thesis is the tide goes out at the end of the third quarter, and we'll see who's got their clothes on, so to speak, i.e.
the Warren Buffett quote, yeah.
Is that you will have all of this, like in Ireland, I believe, where you're sitting, 25% of the workforce, their government is paying their salaries. In the UK, it's something similar. In the US, it's a colossal amount. course, there's all the fiscal stimulus into Wall Street and so on. But literally in the UK, 10 million people's salary has been paid by the government. How
Yeah,
long can that last? Can it go to the end of the year? And what
yeah.
happens
Actually,
when it stops?
the interesting thing is, Sean, what we're seeing now all around the world is the awesome power of central banking. That basically the Central Bank of the United Kingdom, like the Bank of England, Central Bank of Europe, the ECB, and the Fed can go on doing this for a long, long time. There isn't, I think we've got to get away from this idea that there is an incipient inflationary threat that's about to emerge, and suddenly interest rates will go up, and etc. I don't think that's going to happen. I think that what we're seeing is a totally new dispensation with respect to macroeconomic policy. This is a huge, huge moment. And I think we're moving towards much more towards the MMT, the modern monetary theory approach to monetary policy, much more likely than going back to something that pertained in the 20th century. So we can't look at 21st century problems with 20th century ideas. And I think we're talking about a shift. If you imagine, Sean, this time 100 years ago or 110 years ago, the debate in the world was between the gold standard and floating currencies, okay? Now that seems very arcane to us, but at the time that was actually the be all and end all of economics. Now the gold standard looks to us like a ridiculous notion, a ridiculous idea. So I think we're going towards very assertive economic policy. This will mean much, much more printing of money. It'll mean much, much more monetizing of fiscal deficits. It will mean much, much more, as you would say, long-term dependency on the state for wages until the economy recovers. And let's look at the objective. The objective is to make the economy recover. The objective isn't to worry about the debt GDP ratio or anything like this. So that will take time. And then what will happen is, as we've seen in the United States since the 1980s, the American debt to GDP ratio continues to rise and rise and rise. Periodically, those on the what I would call the Baptist right, this quasi-religious right wing, speak of reckoning in a sort of almost slightly biblical sense. It hasn't happened. The model for, I think, Western Europe and the United States is Japan. And you see the Japanese are recycling their debt and using their actual budget and their debt market, the bond market, as a recycling of their savings. So my sense is that we're moving into a new dispensation, and a Biden government.
In that dispensation as such, can the value of money be maintained? I mean, you talked at the beginning about your $1 million a day for 1,700 years. It might become where you'd spend that $1 million in need of wheelbarrow to buy your loaf of bread. I mean, how can the value of money be protected during a period in which such a rapid increase in money supply is being generated? I mean, maybe it's new economics, but it is new economics. Puzzling.
It's only puzzling if you believe that that money. I mean, the very strange thing about money, Sean, is it's actually a conceit. It's actually an imagination, right? This is the very odd thing. You believe it because I believe it because you believe it, etc. It's very clear that if you're a gold bug or if you're a commodities person, an environment of huge printing of paper money will undoubtedly increase the real value of your asset, if it's commodities, anything material. But what we've seen since the 1990s is a collapse of what's called the velocity of money, which is the amount of time money changes hands, which means that that sometimes the more you print money, the less inflationary it is. So what we've seen since 2008, and this is again a conundrum that I don't have all the answers for, I'm really observing as a professional observer. Since 2008, what we've seen, Sean, is a huge expansion in the monetary base and no inflation. In actual fact, we've seen the opposite. We've seen deflation. Now, why is that? And then it's a battle in economics between Schumpeter, who talked about the relentless gale of creative destruction. So he talked about this sort of the implicit ability of the private sector to come up with new products. So he's talking about, let's say, Silicon Valley, for example. And Phillips, who was the guy who believed that there's a relationship between money supply, growth, and inflation. And what we're seeing is this battle between these two schools of economics. My own sense is that what Keynes said is the case. You know, when the facts change, I change my opinion. What do you do, sir? And the facts are that expanding money supply has not led to inflation, but has led to asset price bubbles, which brings us back
I
to
think it's
our...
interesting in a way. It hasn't led to inflation when you go buy your loaf of bread in the shop. But if you're trying to live on Park Avenue and send your kids to private school, or the where that world
Sean,
is,
you hang around with far more rarefied people.
no,
than I
but
do.
if you look at the asset bubbles, I mean, the equity
Yeah.
markets are clearly this zone of inflation, if you like, and if you are in that space, I mean, my school fees for the kids are going up every year, so there does seem to be inflation in the space where a lot of that fiscal stimulus ends up.
It's interesting you say that. Where you're seeing massive inflation is in the non-traded sector. So this brings us to something quite interesting. So your school fees, like if you're an American, right, and you're an American middle class person, so school fees and private health, right, going through the roof. Not just schools, but education in general. Private health going through. Why is that? Because they're not traded. Okay. So then you look at the traded market, where you have the influence of China and India and all the emerging markets. You see this massive drag down. And you see in highly competitive services like taxis, for example, massive technological pressure to bring down prices. So what you're looking at is price gouging, Sean, in the private non-traded sectors, which, as you said, is a reflection of the amount of effervescence in the economy. And there's probably a much greater link between the Dow Jones and private education prices in the United States than private education prices and the demographic pressure, which you would imagine should be the relationship. And that's because what you're buying for private education, Sean, is status for your children, okay? And whether it's a 401k stuffed with Apple shares or a swanky pants Jesuit college on the Lower East Side, you're buying status, okay? And status is something that is very, very sensitive to monetary policy, because status is highly correlated to economic effervescence, right? So I think you're right in the sense that inflation is measured by the petrol pump, the basic idea. So for example, you take this thing here, right? This Yokni bus here, right? These have been deflationary for the last while, okay? You take what we're talking on, computers, deflationary. When I was a kid, you know, in Ireland, people rented their televisions because they were so bloody expensive. Ireland was
Higher purchase.
Hard purchase. Ireland was a country where people bought their houses and rented their bloody TVs. I remember trying to explain that to a German. They were like, sorry, you buy your houses and you rent your televisions? But the reason that was that technology was incredibly expensive. Even if you could describe a pie black and white television as technology in the 70s, right? That has collapsed in value, but because of the impact of technology and trade and China and whatever. But what has gone up, Sean, you're absolutely right, is the private non-sector or non-traded part, kids' education being one of them, private health being another one. And increasingly, the middle classes spend a huge chunk of their income on those things.
And when you think about where that goes in the second half, would you advocate and would you expect this stimulus scale to continue right through this year on the levels we've seen?
Yeah, I do. I don't think there will be any premature change of policy anywhere. I think
so the financial markets should have a great run this year. Then second half,
they should probably have a good run. I mean, basically, the what is determining policy, Sean, is politics. Okay, and the need for the centrist parties and the status quo to keep the barbarians at the gates, okay, or beyond the gates. That's certainly in the European Union, that's definitely the case. And against a background of unlimited ability to print money, and against a background of no huge incipient inflationary pressures, I think what we will just end up with more effervescence in financial markets, maybe bigger bubbles in financial markets across the sectors, and a greater incurrence of national debt. So debt ratios that might have been hovering around 70 or 80% might end up at 120% of GDP. Now, the only way in which that can be sustainable if the rates of interest are kept low, and that means financial repression is around the corner, and that will have much greater impact on financial markets. But that's, I think that's some years away.
Yeah. Let's take a break. And when we come back, I want to ask David to comment on the three big events that I've identified for the second half of the year. Inevitably, the US presidential election. Germany takes over the presidency of the European Union, Angela Merkel's last swing of the dice, so to speak. Where does the China-US standoff go in this second half of the year? But thank you, David, for being on Halftime Talk this week. An absolute pleasure. And we will catch up with you soon again.
See you soon, Tony.
Shukran.